Thank you very much for the introduction. My name is Jeff Prebor. We've had the intros already of people's titles, so I won't do that again. But I'm very happy to have this panel here. The way I operate, we have infinite time because the timer hasn't started running. So you might want to start that, guys, or there'll be no final panel. Thank you. I like to say the agenda, the theme, and what we're going to tell you what we're going to do, and then we'll hopefully do it. I run a tanker shipping company. We're not going to talk about that. We're going to talk about the ecosystem of finance for shipping and where these four panelists and their institutions fit in there and how that can make a difference for ship owners, those of you that are ship owners, or those of you that are advising ship owners, or those of you who have the ear of ship owners, or those of you who'd like to be investors. Could be you. So that's how we're going to go about it. The goal is to entertain and to inform. We've had the entertainment part, so let's move on to the informative part. I hope when we're finished in 29 minutes that you'll have a better idea of some of the capital that's available for shipping today. So I'd like to each of you to introduce briefly yourselves and your institution. Some of you are quite new to what you're doing. Looking at you, Felix. Tobias. So let's start with you, Tobias. Brand new. Tell us about Pelagic.
Well, I'm new to Pelagic Partners, but I've been essentially doing this for 15 years. I worked at a platform called Icon Capital in New York, and then later at Fleetscape, which was part of Oaktree. And now we're building out the same strategy with Pelagic Partners. Pelagic Partners was formed 5 years ago, a joint venture between Atef Abumeri and Nils Hartman. So from two different ship-owning families that have invested capital on behalf of third parties for decades, and really now has professionalized it and created a equity platform to invest into shipping for equity investors. That's been very successful, and now we are adding on a credit platform, which I am now building out.
Thank you. Jake, tell us about ClearOcean.
So ClearOcean is a specialty private equity group focused entirely on maritime. We've been very active in the chemical space, as well as we just launched a dry bulk platform, and then we've made a big push into offshore sector, particularly platform support vessels and offshore construction vessels.
Great. Felix, your turn.
Sure. Yeah, MPC Capital is a Hamburg-based asset manager active in maritime infrastructure and renewable energy. We're quite heavy overweight on maritime activities. I think we are best known to be the largest shareholder of Oslo-listed MPC Container Ships, who spoke earlier on the panel as well, one of the largest owners of feeder container vessels. And we are building and structuring platforms, club deals for maritime investments for institutional investors and family offices. Okay, Jim, we know what DNB is, but where do you fit in?
Yeah, DNB's been around for 200 years. Thank God I'm not.
Yeah. Well, you're getting closer.
Getting closer. We've got an investment banking and securities operation that we've been building out globally now for about 13, 14 years. We focus on three sectors internationally. We focus on energy, we focus on healthcare, and we focus on shipping. Research, investment banking, sales, and trading.
Terrific. So there you have it. We have three panelists that are talking about private investments, two on the equity side, one on the debt side. And we have, Jim, you got the entire capital markets, so that free reign. So that's the context of the questions that I'll ask. First of all, in general, what type of returns are we looking for? So I'll start with you, Tobias, on the debt side. What's your objective, and how does that relate to the cost that is the return that you're generating for your fund? And it is, describe that first. Who are your investors? It's one fund, one sponsor?
Well, there are two sponsors. There are two families, but we are also fundraising from third-party investors as well. But ultimately, we are looking for equity-type returns in credit products. So we're looking for mid-teen returns for our investors. But what that ends up costing the clients ultimately is a function of how much or how advantageous back leverage we can get. So we can be quite cost competitive, even though we're getting very good returns for investors.
Okay. Felix, how about you? What are the return criteria you're looking for?
Yeah.
And who are your investors?
Yeah, with regard to our investors, I think it's, as said, it's quite broadly based. So we're working with infrastructure funds, depending on the strategies that we're after, institutional investors, as well as also dedicated shipping funds or shipping investors. So I would say the range is from low double digits to high teens in the 20s.
And Jake?
So our investor base is a mix of family office groups, private equity firms, and then institutions, primarily pensions and endowments. So we kind of a mixed bag of investors across the spectrum. And our return hurdles are typically a 20% IRR and a 2 times multiple of invested capital. It's more or less our benchmark. If we can't realistically drive those types of returns, we typically stay out of the space.
Okay, and Jim, help us with some context. The S&P had a pretty good year last year, right? And maybe some of the broader markets as well, but I guess the S&P, especially with those mega caps. But what investment returns, what would you say are the long-term expectations in the capital markets broadly, or equity markets broadly?
Listen, we spend a lot of time with corporate clients. We spend a lot of time with large mutual funds and hedge funds in the U.S. and Europe and London. It's a relative game, and it's a game where over the last half a dozen years, the passive funds have taken an awful lot of money away from the active funds, in addition to accumulating some additional money. But it's a game of fear of missing out. You know, every year is a new scorecard, and the last 2 years have been very frustrating to investors because 24 was down to probably less than 7 stocks, and 2023 returns were down to 7 stocks plus Eli Lilly, and if you were in Europe, it was Novo. So the concentration of returns have been incredibly tight. The broader market hasn't started to outperform the Magnificent Seven until July of last year. But once again, it's not a matter of absolute returns, it's a matter of relative returns. You know, the day's got to come where the mutual funds outperform the indices.
Okay, we'll come back to that. But let's introduce the theme of the conference today, which is investing through the cycle. I think when the conference organizers were putting this together, it was perceived that we were just kind of at a peak in most shipping sectors. It had been 2 good years. I'm in the tanker sector. Certainly that had been the case. 2022 was the beginning of our upcycle, aided by geopolitics. 23 was great. 24 started out great. And so I think what people were thinking as the second half of last year, as you put together this conference, is, wow, things are great and are going to stay great. Asset values are really high. How do you find the ability to invest in a climate like that? I'd say it's a little more nuanced now. Just we've had some wobbles. The second half of last year didn't feel very peaky. If you're a public company, you watch your stock price in many sectors go down by half. Since January, we've had it wobble back up, right? Sanctions, et cetera. So it's not just that we're at the peak, but we are in a cycle. And so how does that affect what you're doing? Start with you, Jake. How are you looking at investing today, given where we are in the cycle?
So I think right now, our investment thesis back in 2021 was obviously go long on chemical tankers. And the hardest part about being an investor is when those investments go well, you're at the top of the peak, that's when everyone wants to give you money. And that typically is a bad place to be, and actually having to tell investors, sorry, we're not going to do that. So you have to be really disciplined. And so actually instead of taking that capital and going back into what we did because we knew that was going to be a bad investment, we started looking across the maritime spectrum and finding opportunities where markets were either poised for recovery, in the process of recovery, or in a certain amount of distress where we could get assets at appropriate values. And so it's one of the reasons why we pivoted from chemicals and went into offshore and are looking at dry bulk as well. So
you're saying that you can target those kind of as much as 20% returns with the right opportunity in offshore?
Yeah, there's when you look across this, shipping is so cyclical that if you look across the spectrum of shipping and say, if I can understand these markets and how they function, there's always going to be a market that is ripe for investment. There's going to be assets that are mispriced where there's a dislocation between supply and demand. And it's about finding those those opportunities and deploying capital into them, rather than saying, hey, look at my great track record in chemicals, let me buy more of those at the peak. Those are going to end up destroying what is a really tremendous track record. It'll come time to come back into chemicals. But right now we're looking at other opportunities that is kind of has a better risk return profile.
And Felix, we all know you're associated with an organization that has a connection to containers. Tell us what you have been doing and where you may be adjusting to the cycle and types of investments.
Sure. I think we typically, when it comes to container investments, we try not to take too much of a view with regard to how the market is going to develop. We rather taking a bottom-up approach, basically looking at the asset and how we can reduce our downside risk and how we can reduce residual by being able to structure deals where we might be able to acquire a vessel and then in parallel set up charters that will enable us to come to a risk-adjusted return that is acceptable for us. And then we will start de-risking also on the back of financing and financial engineering below that. And on that basis, we felt that we were able last year also during, let's say, some very dynamic markets towards Q2, Q3 to take advantage of both chartering and S&P market by structuring deals that on a risk-adjusted basis are providing our investors with quite attractive returns while also allowing us to keep in mind the ESG angle and the ESG side of things. So we actually acquired 5 container vessels, which will all be or have been retrofitted in conjunction with charters and still leading to an investment at the end of the charter that will be more or less scrap covered for our investors by the time.
So I'm hearing you probably have had some home runs, you'll have some more, but maybe a little more on the structured side, a little less risk. Your investors, Jake, must be fairly risk tolerant if you're trying to get them 20%, right? You just have to do it, right, buddy?
You just have to do it right. And when after you've done it right a few times, that you start to build credibility within a marketplace, and your ability to kind of, do what you say you're going to do and how you transact and be efficient in doing so is kind of paramount to executing, because shipping it's very easy to decide you want to get into it. It's executing on that thesis in an efficient manner that really determines your outcomes.
And I had that question for later, but let's go to it now. What's the exit strategy? What's the length of hold that you expect to have, or can you allow your investors to get out when they want,
So we intentionally set up our asset owning vehicles to be extremely nimble. So, we held ships for, 2 years. We expected to hold them for 5. I mean, we set up our vehicles like traditional private equity type structures, but the ability to enter and exit a marketplace is paramount to an investor's success in maritime. And so we may hold on the asset for 2 years. We may hold on to it for 10 years. Our initial underwriting for the first few ships that we bought was that we were going to buy them, run them to scrap. And that was our base case. And if we could generate those returns with an exit of just, sell it to your scrapyard, that was a really appealing approach, because you don't have to worry about IPOs. You don't have to worry about selling to strategic. You didn't have to, worry about catching this falling knife on asset prices. And so if that's your worst case scenario, you've got a pretty good downside cover.
And to my other private equity investor, Felix, what's your investment horizon and exit possibilities?
Yeah, I think that primarily depends on the different sectors that we are investing in, as well as the nature of the investors that we are working with. So alluding to the container investments we did, it's typically, let's call it 3 to 5 years, having a conservative approach with regard to exit in secondary market, ideally. But also we pivoted into the offshore wind space, where we are rather targeting infrastructure investors with a significantly longer investment horizon, where we are talking up to 10 years, for example, and also the exit opportunities are a bit more, let's say, diverse compared to what we are looking at when we're targeting our club deals.
Good. And Tobias, so you're different strategies, it's debt, but what sectors are you looking at? What size parameters? Just tell us about where you're, because you're just starting. So what you can't talk about what you've done. What are you looking at?
I think the real beauty of shipping, and I don't think we appreciate this enough as an industry, but it's completely uncorrelated to pretty much everything else. And we've done these correlation studies on asset values compared to other investment, whether it be real estate or stocks or bonds, you name it. We as an industry operate completely differently, which means that there will be opportunities when other markets peak to to countercyclically invest into shipping spaces. On top of that, within shipping itself, different asset categories are uncorrelated to each other. So what impacts values in the container space it will be completely different to what impacts values in the tanker space and the bulker space and so forth. I'm mentioning that because I think we talk a lot about the volatility in shipping, but there will always be opportunities throughout the cycles, especially on the credit side where we sit, because the volatility is ultimately borne by the equity risk, and we're sitting a layer below. So it's a long way of answering the question, and I think there will always be opportunities throughout the asset categories to invest in the credits part of the space. And we're seeing that when the opportunities we're seeing, it's pretty much well spread around.
Got it. Now, Jim, I hope you didn't fall asleep down there. Back to the capital markets. So I think you told me, well, we talked about it before. In virtually every public equity sector related to shipping, 2024 was no bueno, right? I mean, it was not a good year. So you're having all these roadshows. You know, what are investors? Is there any chance to get investment interest in shipping and offshore public equities?
My recollection, there were 5 shipping placements last year. 3 of them had something in common. They all traded up on the first and second day of trading. So we did a placement in Catalina, we did a placement in Hafnia, and then we did a placement with Gary and with Navigator Gas. That one only traded up 16% on the first day of trading. So road shows. The last 2 years, we've done over 100 road shows in the U.S. More than 70 of those are physical. I don't have a massive department. This is very time-consuming. And those are roadshow companies. That's not roadshow days. The average roadshow is usually pretty close to 2 days. A lot of trips to New York and Boston, but occasionally other places. You find out what investors are thinking, and you find out what investors are, what they're interested in when you're sitting down face to face for an hour with a management team. Those are very useful data points. You know, generally speaking, what are investors looking for? Size matters, liquidity matters, dividend is starting to matter more. More and more clients are putting dividend as a criteria, and beyond that, they're looking for performance this year.
Okay, so part 2 of this question is, you did 100 roadshows last year. I did 100 investor meetings last year, right? But you mentioned a few follow-on offerings, but let's look at the overall market, $55 trillion. This is your area, but I looked it up. AI, thank you. $55 trillion market. There were $23 billion of IPOs last year. That's not bad. 0 in shipping, right? There's almost $100 billion of follow-on offerings. You just mentioned the ones in shipping, and a handful. It's certainly less than $1 billion. I'm not getting any money out of the equity markets. Why am I spending a third of my time as a CFO in the equity markets? I'm doing those roadshows. The people want this. They won't see me unless there's a reason. I figured it out because I'm just a blackjack dealer in the casino, right? If the market's a casino, they're going to invest or not. They're going to put it on black or red, but that's hedge fund A buying from mutual fund B or mutual fund A buying, and the money doesn't go to me because my valuation stinks, and I don't want to raise money. So what am I doing? I mean, is this broken, or is it going to get you're turning red? Sorry, I mean, but there's got to be an answer. It must be that sometimes we get to the right valuation, we can take advantage. But you tell me why I'm public.
Listen, is there anyone here from the London Stock Exchange? Good. That would be a horrible place to list. Okay. Raising $50 to $100 million on an IPO and getting no research coverage, that's a horrible way to get started. So list in the US. If you're going to list in Europe, list in Norway. You'll get research coverage. You'll get a sophisticated audience. The capital markets, in my view, they do work. Not everyone I compete against takes the job as seriously as I'd like them to take the job. If you don't spend time with investors, you have no clue other than calling a bunch of hedge funds when it's time to raise the capital. There's a right way to raise it and there's a wrong way to raise it. And I've been in this business for over 40 years. I like this business. I care about this business. And I'm frustrated by the simplicity of some of the approaches to raising money. The markets are brutal, but if you look at this, the end of the second quarter of 2020 through almost the end of the quarter of 24, you had 3 years. Shipping was a massive outperformer.
Yeah.
You know, during that same 3-year stretch, the Russell 2000 made a 5-year low. The broader market didn't participate. Up until June, the correlation of the shipping market in the last 3 years was more like the Magnificent Seven than it was like the broader market. So it's got its days in the sun. And again, getting back to this notion of fear of missing out.
Yeah.
If there's money to be made, investors will get there.
Yeah.
Even if they say, I'll never invest in shipping again. And you and I have both heard that.
Yeah. And, you know, I was winding you up because you're an old friend, but this equity market is broken, blah, blah, blah. I'll answer my own question, why am I doing it? Because I'm owned by a bunch of public equity investors, whether it's hedge fund A, hedge fund B, mutual fund B, or widow and orphan. That's who owns my company, not some private, ship owner or whomever. So my job is to try to provide total shareholder return to them by investing in shipping, giving dividends, and driving the results up. So yeah, I'll keep spending a third of my year on that and trying to do that job. So, but hey, back to my private guys. For the companies or projects that you invest in, Jake, you're providing an alternative to what? I mean, if they don't get your investment, the project doesn't get off the ground, or is it because they can't do an IPO because that isn't working right now, or what?
So we have kind of two ways of looking at investing in shipping. There are the operating companies that we like to buy. So if we find a sector we like, the first thing we do is we find an operating team with boots on the ground that has real expertise, that has real inside knowledge on how that sector works. So when we got into chemicals, the first thing we did was we went out and bought a company called Womar. Really just fantastic people, know that market inside out and backwards. As a result of that, now I can go out and I can provide investors with an opportunity to just own assets, right? So when we go think about how to get into a market and then exit, it's easy when all you own is the asset, right? When you're trying to, when you're a private equity fund and you own 50 ships and you've got, this huge infrastructure, try to sell that company. It's going to take you 12 plus months. Your strategic buyers really just want the asset. And your IPO markets, as we know, they've been closed to most folks. And so if you're an investor and you just own the asset, you can call up our broker and in 3 months the ship's delivered. And the money's back in your back pocket. And so we've kind of looked at this and said, let's bifurcate this. Let's let us own the operating companies. We can scale them up, we can scale them down, and just give the investors the opportunity to just invest in assets. And to your point, it's a great hedge against inflation. It's counter-correlated. Typically, when other markets are all messed up, and there's all sorts of supply chain disruptions that are causing problems, shipping loves that. And so it's very countercyclical, and it just keeps things simple from an investor standpoint to not have to think about all this infrastructure in order to run a shipping company.
Sort of related to that, but on to you, Felix. How do you find your investment opportunities? What doors are you knocking on this year? Where are you going? What types? How do you get deal flow?
Well, I think with regard to sourcing, first of all, the deals, obviously similar to the previous speaker, we also have larger setups with regard to the operating side, both technically and commercially. So we feel that we have good access, in particular to sectors that we are very active in, and then also on that basis sourcing into other operating partners. I think that's one. And then pivoting on the investor side very much on successes of the past, basically. But also diversifying in terms of the investor base that we have and relying also on good partners on the sourcing side. So obviously, we're trying to tap every market that we can.
Yeah, and Tobias, we had an alternative credit panel earlier. You didn't make that one, but thank you. You came to mind. I'm so happy. So you got this to yourself. What are you an alternative for companies? What companies are, what was your best opportunities, you think? Are you complementary to banks, or are you an alternative to banks?
I think we're complementary to everything, honestly. I think this is ultimately a relationship business. We will enter into conversations with our clients. What do you need? And that might be an equity investment, it might be a debt investment from a bank, or it might be something in the middle, which is what we provide. And we try to be more creative and more flexible than either other alternative. We've done deals together, right? So it's not necessarily. Maybe in that situation, I guess I should ask you, what was the alternative there? Was that a bank or more equity? It really depends on the situation.
Jim and Kevin, Marine Money's favorite thing, doing deals on stage, right? Let's do it. So, look, I think a quick one, size. What sizes are you focused on of investments, Jake?
So our typical
Top to bottom.
our typical equity raise is anywhere from 20 to 100 million is typically what we raise on a per tranche basis. That allows us to be kind of really nimble in terms of how we structure the capital stack with debt and equity.
Okay.
And that's typically
Got it.
how we're at.
Felix?
Can be as small as 10 up to 100, 120.
Okay. Tobias?
20 to 100 is that's fairly typical, but it's a very wide range, and we've gone significantly larger than that as well.
Jim, the sky's the limit, right?
Sky's the limit, but I'll tell you what the floor is. I don't think you can raise less than $200 or $250 million, and we try to get companies to a free float of $500 million as fast as we can, an average daily volume of over $3 million a day as fast as we can. If you look at the deals that performed best in 2024, and I know it wasn't a massive IPO calendar, but the deals that performed best had raised over $200 million. The smaller deals perform badly.
What's good liquidity in a trading volume, dollars per day?
What's the liquidity hurdle for accounts? Minimum is 3. Some have moved that up as high as $7 million a day. And so what happens is if a fund manager wants to put in an order for something and then compliance takes a look at it, the fund manager doesn't know it until they get the allocation, but the compliance department made the order a lot smaller.
Okay. So listen, agenda was to educate, I hope, inform a bit. You've got some perspectives on these gentlemen and their institutions and how they are part of the ecosystem of bringing equity and debt capital from either the capital markets, from private investors to ship owners like me, or private investors like Prestige Worldwide, which, by the way, would be a terrible name for a shipping company. But we've got just a couple minutes left. Are there any questions from the floor? No time? Okay. Well, then, thank you very much, all my panelists.